Passive Pockets is presented by Equity Trust. Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm your host, Paul Shannon. Today, we're joined by industrial real estate investor Joel Friedland. Joel has built a reputation for taking an unconventional approach in the syndication space, foregoing traditional high-leverage strategies in favor of all-cash or low-debt acquisitions. He's navigated multiple market cycles, learned hard lessons from downturns, and developed a disciplined philosophy around risk and investor protection. We'll talk about how he evaluates industrial deals in the Chicago market, how his approach impacts capital raising, and a creative strategy he's using to offer liquidity to long-term investors through Rule 144 without selling the underlying assets. Let's jump into the conversation. Joel, welcome to the Passive Pockets podcast.
Good to see you, Paul.
I'm excited to have you today. We've known each other for a couple of years now. I've been looking forward to having this chat with you. Before we get into your extensive background and experiences, tell us about how you got into real estate, specifically industrial real estate in Chicago.
Yeah, well, I graduated from the University of Michigan, and I was looking for a job in real estate. I knew I wanted to be in real estate. In my community where I grew up in Highland Park, which is a suburb of Chicago, there were several at that time, which was in the 1980s, super wealthy real estate people who were sort of like they had the high visibility in the community as being super successful at their real estate world. And I was very interested in figuring out how to get into that, and I had no idea how to do it. So I was sitting in a jacuzzi with a guy who was a friend of mine at a health club. And he said, you got to call this fellow Milt Podolsky. He's got industrial buildings. He's got 80 industrial buildings. He's a big deal. So I got out of the jacuzzi, and there were no cell phones. So I went to the payphone, and I immediately called this guy. And I said, Mr. Podolsky, I was referred to you by my friend Mark. He says, oh, I know Mark. He says, when do you want to come in? I said, when do you want me? He said, now. So I got dressed, and I went to his office. And he interviewed me for 10 minutes and asked me a bunch of questions and said, young man, you're hired. Let's go. I knew nothing about industrial real estate. It was just a cold call. I worked for Milt and his two sons, Randy and Steve, and his daughter, Bonnie. They mentored me for 10 years in industrial real estate. I was a leasing agent. I was a property manager, and I helped them do syndications. And I invested in my first syndication, $2,500 with Milt when I was 22.
A fortuitous introduction to Milt, indeed. So I want to fill in the gaps between then and now, in a 40 years time period there. But take us from point A to point B. What does your portfolio look like today with Brit Properties?
So today we have 23 industrial buildings. They're all in Chicago. We did try doing some out-of-town deals in New York and Florida and Ohio. I went through the 2008 downturn, which was my fourth downturn since 1981. I'm 66, so I've been through the mill. And what happened was in 2008, I got crushed. I was a syndicator. I had bought 50 buildings at that time. Milt and his family taught me how to do it. And I went and started my own business with another group of guys. Stayed very in touch with Milt and Steven. And by the way, Steven still invests with me to this day in his 70s. So we're still very close. But 2008 was a time where I learned what it meant to be vulnerable because we had 50 buildings. We had 10 that were in deep trouble. I had 7 banks and owed $70 million in guarantees.
This is all recourse debt, all that you're on the line for.
It was a disaster. So I ended up falling into what I would call a deep clinical depression because I thought, oh my gosh, I've lost everybody's money. We have a local business paper here called Crane Chicago Business. I'm going to be a headline in Crane Chicago Business. Joel Friedland fails spectacularly. So it was really, really rough. I had debt on all those deals. And I looked back at that after sort of recovering. I went through a lot of years of really tough times. I started feeling better through a series of things like medication and meditation. I came out of it. I have to tell you, when I was in that situation with the depression, my parents were both therapists, were really worried about me. My wife was keeping her eye on me to make sure that I didn't take pills. I mean, I was really that bad. And the pain of that, Paul, was so great that I rethought everything that I was doing and changed my entire approach so that from then on, all I was going to do was really low risk deals. They say if you don't take a lot of risk, you can't make a lot of money. That's not true. You can go low risk and you can still do well. What happened was I decided to go debt-free on almost all of our new acquisitions with a 30% maximum loan-to-value ratio. So our current portfolio of 23 buildings has an average loan-to-value ratio of 18%. Some people think it's crazy. They say, what are you doing? How do you make a lot of money in real estate without a lot of leverage? And my answer is sleeping better at night is more important. And I've been assembling a group of like-minded investors who feel that the low-risk approach to real estate makes more sense to them than some of the things they've done in the past where they've gotten in trouble.
I really appreciate you being so transparent and sharing that vulnerable time period in your life and in your business. That's really powerful to come out of that with the lessons that you learned from it. Stronger, I'm assuming now, because you're still here today, decades later, and really making moves in the space. So I want to kind of talk a little bit more about that no to low leverage strategy, either no debt or maximum of 30% LTV. You just don't hear that in the syndication space, right? You hear about the power of leverage. You hear about how debt is potentially dangerous. It can burn down a house, but can also cook a great steak. And a lot of people that's actually a quote from a past podcast guest that we just had on not too long ago, I thought was clever. But a lot of wealthy individuals talk about the power of leverage, the power of using debt to amplify your wealth. So, you had troubles in your portfolio and you want to take lower risk, but what was the process that went on and how did you, I'm sure you consider maybe getting out of the space. Was this sort of a happy medium? How did you arrive at this conclusion that this was the way to go forward?
So I started out as an industrial real estate broker working for Milton and the Podolsky family in the 80s. And then I started my own brokerage and acquisition and syndication business 10 years later. And I built that up and eventually sold that to a company out of Texas called Transwestern. What happened was in 2008, when I was in so much trouble, I was in no position to buy anything. I went back into the brokerage business and I became an industrial real estate broker almost full-time from 2008 until about 2019. And I could make a pretty good living. Industrial real estate brokers today, most of us who've been in the business a long time, belong to an organization called SIOR, which is the Society of Industrial and Office Realtors. And people in that organization, most of them make a seven-figure income by introducing industrial tenants to industrial landlords. Industrial has some really large buildings, like the Amazon type buildings. If a broker brings Amazon to a 1 million square foot building, the commission is $3 million. So I was in a position where I just didn't have the internal emotional capability of taking risk the way that I had that got me in so much trouble. So I was brokering deals and making a living. And in 2019, which was 6 years ago, I turned 60. And I said, most brokers are not old guys. And there's a saying, brokers die broke. I said, I've got to get back in to owning buildings, but how am I going to do it? I found an older gentleman whose name is Nate Wagner, who had made a tremendous amount of money in real estate. I became friendly with him and he started investing with me. And I did my first new deal alone with him without syndicating. I put $50,000 in, he put $950,000 in. It was $1 million deal. And because we bought it with no debt, no matter what happened, we weren't going to lose a lot of money. And we ended up owning the building for 2 years, and it was a bad deal. We made 4% a year. We had some vacancy. I'm glad I didn't have debt on this, because if we had debt on this deal, we would have lost money rather than making 4%. And he said, there might be something here, Joel. Maybe we should do deals with no debt so that we don't lose. Well, that's kind of a defensive position. There's the scarcity and the abundance theory. He said, forget all that. Your emotional health and my emotional health of my money. I'm happy with staying power and being able to sleep at night. So if you want to become a syndicator again, I'll be your biggest investor. Go out and start over again. So in 2019, with that first deal, and then back to 2021, I was back in the game and doing deals with no debt. And it's interesting because I still had 250 investors who were sort of hibernating from my old deals that went back that we still owned from 1990 all the way through 2008. And I contacted all of the hibernating investors and I said, guys, I'm changing the way I do things. It's going to be debt-free. We may borrow 30% on some deals or 15%, but is there anybody who would join me in doing those kinds of deals? And surprisingly, 40 of my hibernators said, Joel, you got us through that really crappy time in '08. You didn't go bankrupt. We still have our investments. And they said, find us a deal. So I found the first one, which was a 33,000 square foot building on Tripp Avenue occupied by a manufacturer called Steiner Industries. And I put the deal together and we raised $2.7 million from about 60-ish people. And from there, we went and did more of the same thing, debt-free, very low debt, and built up this newer portfolio with safety first.
With Nate at your side, that definitely helped from a confidence standpoint, from a capital standpoint, and going through that experience where you had a rocky, maybe business plan unfold and still earned 4%, kind of validated your perspective that maybe debt-free is the way to go. But on the other side of the coin, when you go debt-free on acquiring these assets, you give up some of the returns that you could potentially get, right? You're not leveraging the banks, so you're not paying down that note, growing your equity in that fashion. You're not able to amplify your returns with that debt. So really, whatever cap rate you buy the property at, let's say net operating income is $60,000 on a $1 million building, it's a 6% cap rate. It's also going to be your cash flow if you have no debt, because there's no debt service that's going to erode that net operating income. So that's really your return, right? You're kind of hoping that appreciation kicks in, but you're buying a coupon more or less. So does that make raising capital more difficult?
Well, first of all, raising capital is difficult, no matter what, no matter how good the deal is. So we bought 5 deals this year up till August. It is extremely difficult to raise money in a hurry for a deal when you have to raise all of the money. So our most recent acquisition was a $3.5 million property in a place called Harwood Heights, Illinois, which is right near the city of Chicago. 2 manufacturing buildings, 20,000 square feet and 18,000 square feet. And the most important thing is that these buildings are leased for 8 more years to a manufacturer on a triple net where we have no expenses whatsoever. The tenant pays everything. I had to go out and raise all that money, but here's the real big problem. If you buy a $3.5 million property with 70% debt, you're only raising about $1.5 million. I have to raise the whole $3.5 million, which makes it 2.5 times harder to do the deal because I'm not using that leverage. A lot of people use leverage and it makes them really wealthy because they're able to expand, like you said, they're able to expand their portfolio because of the leverage. With my philosophy, I can't do that. And by the way, I'm not against people using leverage. I think investors should be in multiple kinds of deals, diversified all across the board. Just for me and for my group, it's debt-free. So for that little corner of somebody's portfolio, if they want to be in something where they just feel super safe and where they can sleep at night and not worry about Joel calling them and saying, the bank's telling us to pay down the loan. Interest rates went up. When interest rates went up, I'm not saying we didn't care. It was very hurtful to real estate. But in our case, it didn't matter. We didn't have to refinance because there was nothing to refinance. It was just all cash equity. But here's the thing that is the most difficult. You go under contract to buy a building. So these 2 buildings are perfect. I have a way that I look at deals. The layout of industrial is everything. The geometry of how the building sits on the site. It has to have the proper parking. The parking cannot be in the back because people in Chicago don't want to walk around the building in the middle of the winter to get to the front door. So the parking has to be on the side or in the front. The ceilings have to be a certain minimum height. It has to have loading docks that are really easy for trucks to back into. And the shape of the buildings have to be perfect. So these 2 buildings were perfect. But we went under contract and we had 30 days to do due diligence and then 15 days to close. The question is, how do you raise $3.5 million in increments of $50,000 and $100,000 in 15 days after our due diligence is up? If it had been a deal with debt, if we had borrowed 70%, So we had borrowed $2.5 million and we had $1 million of equity. I could raise $1 million in a minute. $3.5 million takes a little longer. So what we did, Nate and I and his family and a few other investors, I don't think I've told you about this. We put together this mini fund, which is for the sole purpose of being able to buy buildings without having to syndicate them until after we close. And then we backfill and then we recycle the money to buy the next deal.
So it takes a little pressure off as far as the timeline is concerned, and you can extend the raise.
Right. And then I can syndicate afterwards. And if it takes 3 months or if it takes 4 months, we can make the right decisions with the right investors. It's such an incredible feeling of comfort to be able to say to an investor, let me ask you about you and what you're interested in. I'm curious about your philosophy and your strategy. And say to someone, I don't think this is the right deal for you. And not be worried that we're not raising the money from that person for that deal.
So let's hone in on that a little bit. When you talk about what investor fits the buy box of what you guys acquire, who is that? You said somebody that's looking for something a little bit more safe, but can you elaborate on that a little bit?
Probably the same people that you guys talk to. We have doctors, lawyers, people who've sold their businesses, people who run companies. They're all accredited. But I'd say in general, at least 3/4 of them are looking for long-term income to supplement their lifestyle.
And it sounds like these holds on these deals that you do acquire are quite lengthy. You said you have some assets that you still hold from the 90s, correct?
Yeah, we hold long-term. And first of all, to give you a little bit of background on the numbers, we will not buy anything unless there's a 7% yield to start. We try to do 7.5 and 8. So looking for deals is really important. We're always hunting. And we buy almost all off market. We've bought over 100 buildings. We've only bought 3 from brokers. The other 97 or whatever the number is, we're all off market. And what we do is we have a cold calling program with people who are going door to door in industrial parks, including me. I do this also. This summer I had 6 interns and we went to the town of Wooddale, which is near O'Hare Airport. And we divided Wooddale into quadrants. Of the 202 buildings in Wooddale, we divided them up so that each person had 30 buildings. And the job for the summer was for them to know every detail about every building in Wooddale. We're buying a building in Wooddale. It's a $3.8 million deal. The company that is in there was contacted by one of the young guys in our office who called 6 times and then went to the building and actually waited for someone to come out the side door with, he said the guy was carrying a McDonald's bag. He says, who owns this building and how do I get to him? And the guy with the McDonald's bag gave him the name of the owner, this Mario. So Logan calls Mario and says, I've been trying to reach you and I didn't have the right number. So the guy who worked for you gave me the right number. Would you consider selling your building? And Mario said, it's interesting, Logan. I've gotten all your calls and I never really thought seriously about it. I'm going to be consolidating my operation into Nashville where I have a bigger building, and I will be staying in this building only for a few more years. Would you guys consider buying it and leasing it back to me? Well, that was music to Logan's ears. He said, of course. So after much negotiation, we ended up agreeing to buy the building. We're closing in 2 weeks. And while we were out in Wooddale, one of the other interns found another building occupied by a family business that the father built the building in 1987, and the family's still in it. The dad died, and the twin sisters own it. And I'm trying to get them to say yes to selling it to us. Perfect geometry. Parking in the front and on the side. High ceiling for a small building. Great office layout. And a loading dock that they filled in, but that we could dig out for about $7,000 if the tenant leaves and we need a dock. That's how we find deals, and it's really difficult to dig them up. Once we find them, the question is, why would we sell them in 3 or 5 years? They're great buildings. They're perfect. So if we sell them, how are we going to find a more perfect building? And the answer is we won't. So we retain them. And then I guess the question is, who's an investor that likes to be in a deal for 20 or 30 years? That's a big question.
That is a big question. Liquidity matters. Estate planning matters. Priorities change. Goes back to the question I had before for you about who this investment is for, what type of investor. Is that an objection you get often, or how do you overcome that?
We get the question, but it becomes not an objection because when we explain that we're long-term holders and rents in industrial buildings generally go up every year. So we say, look, if you're starting at a 7.5% yield and we own the building for 10 years and it goes up a little bit each year, you're going to be getting 10% in 10 years. You're not going to want to sell that building, and neither am I, and pay taxes, because you're going to pay recapture taxes on the depreciation, which a lot of people don't know even is a thing. You depreciate a building each year, and especially if you do cost seg up front, which we do, there's a lot of depreciation. When you sell it, you have to pay a 25% tax, which is recapturing or paying the government back for all of the depreciation that you took. Plus you pay capital gains on the sale. So someone puts $100,000 in, they're now making 10%, they're now making $10,000 a year 10 years later. And they're still getting some tax benefits, and the value theoretically is still going up, and the rent is still going up. I can't shake them loose. Nobody wants to sell that, because where are they going to get something like it? If they pay the tax on the $100,000, they're going to get $80,000, maybe $75,000 after tax. They're going to invest that in something that's either riskier or that's going to give them a lower return by half. I can't shake people loose. My investors like staying in. That's why I have all these hibernators. They're not looking to get out. They like getting their quarterly distribution, but I do one thing in case they want to get out, which is every 5 years, I come up with a way to get out the hibernators who want to divest.
How do you do that?
Right now, I'm putting together a fund, which is going to be bits and pieces of 18 of the buildings that people are in and have been in for a long time. I'm going to the hibernators, and I'm telling each one of them, if you really want to get out and exit my stuff, I'm going to get people in, and they're going to buy in for the equivalent of a 7.5% yield, which if you think about it, it's roughly 13 times their income. So somebody who has a $100,000 investment with me, I tell them you're probably going to pay tax if you sell this. You'll get $75,000. And I'm happy to get you out, because this fund I'm putting together, I'm going to give it to all of the investors and some of the newer people, all of the newer people who've invested with me. And I think I'm going to be able to get everybody out with no discount, just so long as you understand that the new people are getting the 7.5% return that you'd be getting if you stayed in.
So you're almost creating like your own secondary market, really, right?
Yeah.
You're creating liquidity in an otherwise illiquid asset.
Yes. We did a Dutch auction in 2019 where it was a sealed bid situation to get people out. And in that year, I didn't have all these new investors because I just, as I mentioned, I restarted being a syndicator in 2019. So that was difficult because we didn't have enough of a trading floor with enough demand that the supply, that the sellers would get paid what the properties were worth. So the people who got out in 2019 took a 30% discount to the then value. Today, I am able to get people out at the 7.5% yield to the new people coming in. And I've been able to do this on a selective basis, as people have said to me, someone passes away and they had $200,000 with me and they had 4 kids. I get a call from the lead brother. Hey, Joel, it's Benji. Hey, Benj, haven't talked to you in a long time. Well, you know, Dad died last year, and my brothers and my sister, we have this $200,000. We each have $50,000. I'm not sure which one of us would like to stay in or which ones of us might want to get out, but how do we get out? Here's what I do. I circulate the fact that there is equity available in this deal. And that deal, by the way, has the U.S. Postal Service and our Chicago professional soccer team as tenants, really great tenants. And so when I circulate it and I say to people, Benji and his family would like to get out of their $200,000 worth of investments, people contact me and say, I'll take it. I'll take 50. I'll take 100. And I've been able to do what's called an assignment agreement. It's a 1-page agreement where the new investor steps into the shoes of the old investor, but they get something called the 754 election step-up. So it's as if they were investing in a new deal. They don't get stuck with the old investor's basis where they'd have to pay taxes. The old investor pays their tax. My accounting firm keeps 2 columns. One column is the old investors. One column is the new investors that are at the 754. And so Benji, let's say, and his family all sell out. And I have 4 new investors. And this is something the SEC has a rule on. It's called Rule 144. If someone stays in for a year, and that's a requirement, because you can't buy an interest in an LLC through the SEC and Regulation D. You cannot do it with the intent to resell, which means you can't sell it for a year. That's the rule. I can get anybody out of one of my deals today to another investor within a week. So I'm just taking that idea and giving all the hibernators an ability to get out, and all of the people that like this stuff to get into a diversified group of low leverage, 18 buildings, 18%. It's not a coincidence. I want to keep it simple because I'm 66. To remember one number is so much easier. 18 buildings, 18% loan to value ratio. And so we're going to test it. We're going to put this little fund out where people will invest in all 18 buildings and theoretically stay in for the long term. But if they need to get out, I have this mechanism.
I think it's really cool. I mean, overall, the business plan, as we're having this conversation, is starting to come together for me. I think that that's a great value to your investors to be able to offer that potential for liquidity. I love the grassroots approach of going door to door and really knowing your market and who your potential acquisitions will be, or what your potential acquisitions will be. And it sounds like your team gets some pretty good exercise during that process too. So that's a side benefit, right?
They have to drink a lot. It was a hot summer.
I bet.
Where you are and where we are, it was a really hot summer.
Yeah, if it's like here in Indianapolis, it's been very humid and hot. So let's talk a little bit about Chicago. Maybe not the weather, but just the industrial real estate market in general. You know, you've been through a lot of cycles: the savings and loan crisis, the GFC, the most recent peak that we had in the last couple of years. How does the market look today? Is it a good time to acquire real estate, or is it a better time to sell?
It's always a good time to acquire good real estate at a right price. Always. Tomorrow is too late. Today's the day. Today's the day. If you wait till tomorrow, you're going to miss the opportunities of today. And so we're super selective. We look at 500 deals for every deal we buy. We believe you have to talk to a seller 7 times before they even know that you exist. So we send them emails. We call them on the phone. We stop in and see them in person. And we're going to probably buy 3 more buildings in the next 90 days that were all picked up from cold calling.
Excellent. So you're active in the market, and you said you underwrite to a 7% yield. Is there any other important criteria that you look for in a building, maybe the physical characteristics, or an industrial? It's not just the building itself and the location. You also have the creditworthiness of the tenant, the lease term. What are the most important factors to you when you underwrite a deal?
Yeah, those are all important. We do look at the creditworthiness. We ask a lot of questions of each tenant. One of the big questions is, how many customers do you have? Because we had one tenant that was a printer about 12 years ago that was in one of our legacy properties. And he had one customer that he was printing for. And the person that had worked with his father before him and with him to buy printing for this company retired. And a new woman came in and said, "Hey, I have my own printer." So he called me up. He says, I'm going to have to go out of business. I'm losing a customer who's the majority of my business. The ideal business is a company that sells a small product to 100,000 people. So if any one customer disappears, it doesn't even matter. For manufacturers, I want to make sure that no one single product or customer makes up more than 10% of their business. We have a tenant called QCC, which is a manufacturer of pumps and motors for tractors, replacement parts. They have about 9 different manufacturers: Caterpillar, Komatsu, people who make John Deere, who make tractors for farms. And they have never lost a customer, and they've got lots of customers because cost of making the mold to make the particular pump is super expensive. So once they make that mold, they own the mold and they warehouse it in one of their buildings. And then when John Deere calls and says, "We need more of these," they don't have to tool up, and it doesn't take any time. They can just set it up in their manufacturing operation to start making that particular part, and they're up and running in 2 weeks. So they don't lose customers. That's the perfect tenant. And we bought 2 buildings that they occupy. It was a family business started in the 1950s. The Michalek family owned it, and they sold it to a private equity group. And the private equity group brought in the CEO to be a co-owner with them. So he's got skin in the game. And so QCC, if you look them up, John Gorham is the CEO. If you call him and say, how's Joel? He'll say, "Well, he's a tough landlord, but he's a good friend." So those buildings are perfect. First of all, we bought them at a good price per square foot. There's 8 years left on the lease. We're making a 7% return. And the buildings lay out ideal, where they're a rectangle 100 feet across, 200 feet deep. Both buildings are across the street from each other. And the loading docks, there's one loading dock with one building, which is not as good. You're better off having two. And the building across the street has two loading docks. And these buildings they're air conditioned, and they have a tremendous amount of electrical power, which is what manufacturers need. So I want to own these buildings forever. They're so great. Like, how do you replace that? What do you do when you sell those? So what I don't understand with some of the people who are syndicators, well, I do understand it. Buying and selling allows you to make carried interests, and you have to ring the bell to make money. But some of these complexes, they're so fantastic. There's these Class A multifamily buildings. I would hate to drive by one and say, I sold that one a few years ago and now it's gone up 30% since I sold it. I drive by every one of the 80 buildings we've sold, and I regret every sale, every single one. The buildings would be worth so much more today. The rents would be up. I just have the philosophy that if you keep them long term, good things happen.
I would agree. I think syndication has its place, and I liken it more to like a flipping a house than buying and hold, if you're talking about single family rentals, where most of the people that have really made long-term legacy wealth buy assets and they hold them forever. They never sell them. And then their kids get a step-up basis when they pass away. So the syndication model in certain market cycles, you have to have the market participate and help and give you the tailwinds to really get you those big gains. You're much more likely to get caught in a bind if your business plan is short term. So you have to have multiple exit strategies if you're going to play in that realm. Chicago, I don't know if it's like other markets in the United States. It's the center of the country. It's obviously, I think, the third biggest city in the country still at this point. Very mature as far as the industrial market, I'm presuming. Nationally, we've seen a lot of supply come online, just like in multifamily and self-storage and every real estate asset class when money was basically free, when interest rates were zero. Stuff was getting built here, there, and everywhere. Did Chicago experience that supply glut?
Yes, but I'll tell you that we're in a different market than that supply glut. Chicago has 16,000 industrial buildings and 23,000 industrial companies. It's probably the best single industrial market in the country in terms of a self-contained area and from a location standpoint, because this is where the rail cars come through. The center of the country, rail goes from one side to the other, and trucks also, they drive on Highway 80. It's the perfect location, and it's the center point. It's the reason that so many institutions and wealthy people like to own industrial here. But the buildings that we buy are under 40,000 square feet. Nobody's building them. There has been no new supply in 7 years. There have not been 7 new buildings of that size built. The reason is replacement cost is $250 a square foot for the little buildings. Now, there's been a massive amount of gigantic warehouses being built for the Amazons and for the Targets and online sales and manufacturers of products that want a big building that's got lots of loading docks and very high ceilings. And it's a different animal. So that is what's known as Class A industrial. And we have in Chicago 1.3 billion square feet of industrial. And in the past few years, that has gone up from 1.2 billion. So there's been almost a billion square feet added to our market. None of it in our Class B stuff, because no one's building them, because A, there's no land for it, and B, it makes no sense to build a building for $250. We're buying buildings for $120 and $130. So we're buying for half of replacement costs. There's no way we could build a building and make any money. Besides that, I've gotten crushed in development. When I used to do some developments, I've developed 30 industrial buildings. My batting average is like a baseball player, really bad. Baseball players hit 1 out of 3 when they're superstars. You bat 330 and you make $40 million a year. I was batting about 350 for my developments. A lot of break evens, a lot of not making any money, because you're building at the top of the market, because labor's at the top and materials are at the top at all times. So I've tried development. Sam Zell, I went to a conference once and he said, don't develop. And I didn't listen. And now every time I listen to him on a podcast, he's passed away, but every time I hear him, don't develop. And I think, why didn't I hear that when I should have heard that?
Listen to the grave dancer. He knows what he's talking about.
Yeah, so it's a gigantic market. And one of the things that's most important, I don't know any other market where this is the case, any other kind of asset class. We don't sell our buildings on a cap rate. So we don't care about cap rates. We sell to users who pay a 30 to 40% premium because so few buildings come on the market that when somebody's in 15,000 feet and they need to move to 30,000 feet, they can't find it. Nothing's for sale in that size range, which is why it's so hard for us to find deals. We end up selling when we sell to someone who may be next door or 3 blocks away because they don't want to move. They want to expand by getting plant number 2, a second building down the street, because moving their equipment from a 15,000-foot building into a 30,000-foot building could cost them $1 million. In the case of Tampico Beverage, they have 2 buildings on the Chicago River that we own. It would cost them millions to move, and their rent's only $1 million a year, so they're not leaving. Those are called sticky tenants. But when they do leave, we've got something that's so valuable to a user that it makes no sense for us to sell at least to someone who wants a 7 cap. A 7 cap on a building might be $3 million, but to sell it to the neighbor 3 doors away might be $4.2 million. Back in the heyday, I bought a building from a Budweiser distributor for $3 million and sold it to the guy 2 doors away 30 days later for $4 million. Made $1 million on a sale within literally a couple months. And we've done that over and over. Again, I regret every one of those because they're all worth much more now.
Sometimes you got to take the quick wins when they're right in front of your face, though. So
yeah, it's just I've learned 40-something years in the business that, yeah, we could take the quick win, but we're going to regret it because it's going to be worth so much more and the rent goes up and we don't want to pay our taxes.
Well, Joel, we're getting towards the end of the interview here. I really appreciate you coming on. I have one more question to kind of tie a bow on this, and it's related to track record and how passive investors should approach different opportunities, not necessarily with Brit properties in your firm, but just on the whole. The space has gotten much more crowded lately. You hear people that have come in and have a few years of experience and they've got a track record, quote unquote, and you should invest with them because they've learned so much. Meanwhile, a guy like you's been in the space for 40 years. You've been through 4 market cycles. You've learned some hard lessons, come out the other side. And to me, you have an actual track record. So what would you say to a passive investor as far as what should be their most important criteria? How do they cut through the noise and get to the real sponsors who know what they're doing and know what they're talking about and basically build a portfolio from the ground up?
Well, this will be a surprising answer. The number one most important thing is what's your succession plan? Because there's usually one person who's the driver in the company, who's got the idea person and the relationship person and who understands everything. Is there somebody that will take over if something happens to you? Especially now being 66, I've been to a lot of funerals. People don't live forever, and people have illnesses, and someone might get MS and they can't function as well. Or we've seen all this. So the number one question is, what is your succession plan, and can I see a copy of your document for your succession plan? And I literally give people my succession plan document, and it's very, very well thought out. Someone who thinks through their succession plan well enough that they have a document that they're willing to share. So the Wagner family, Nate Wagner, in my case, he and his family are one leg of a 3-legged stool if something happens to me. My family, I have a young partner who knows everything that he needs to know to be really good, Eric, and the Wagner family. And if something happens to me, there's 3 voters for major decisions. And there's 4 major decisions with all real estate deals that are important, not like what color are we painting the back wall. But that's number one. And if someone's got that down, I know they are a thinker and that they're strategic. And now the next question is almost irrelevant because I know already who they are. The next question, though, would be about the debt. I want to see your loan document because our loan documents, we have 14 loans on the 23 properties. The rest of them are the debt-free. And my loan documents, which are the Laser Pro documents, which most banks use, I have a side letter which has 8 separate items on it that say, despite the fact, notwithstanding the fact that we've signed the loan documents, these 8 items are exceptions to the way that your documents read. Like we take out the insecurity clause, we take out the cross collateralization, the third party default. If you have a loan at a bank and you're in default on one deal at that bank and you have 3 other deals, they can put your entire relationship into the workout department. So I want to see how smart they are about the money that they borrow. I want to see what their document says and how bad things can get if things get bad, in addition to seeing what their payments are, what the maturity date is. So I get way into the details on those 2 things. Then I start asking about the economics of the deal. It's interesting. Those are almost the last thing. You assume those are good. If those aren't good, the first 2 don't matter anyway.
Yeah, that's smart. It's not what I expected you to answer with, but very, very thought out and very unique approach that I think will serve you well. So, hey, I appreciate you coming on today, Joel. I've really enjoyed the conversation. I love your approach. And if people want to learn more about you and Brit Properties, where can they find out more information?
Our website is britproperties.com. That's BRIT with 1 T.
All right. Thanks, Joel.
Thank you, Paul.
Whether it's limiting leverage, structuring deals for stability, or finding creative ways to give investors liquidity, Joel Friedland's approach to industrial real estate investing is a reminder that there's more than one way to build a resilient portfolio. A big thank you to Joel for sharing his insights and experiences with us today. If this conversation sparked new ideas or challenged your thinking on risk and capital structure, make sure you subscribe to the show and check out PassivePockets.com to join our investor community with a 7-day free trial. Thanks for listening, and as always, happy investing.